This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Well, let's dive right into it. Listeners, the chart deck is titled Big Picture Look at Commodities. You'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to the homepage, macrovoices.com. Click the red button that says Looking for the Downloads. Patrick, page 2, dollar index. What's going on?
I hear a lot of times you referencing this in the market wrap, and then when we talked to Brent about the dollar as well, it really made me want to just zoom out on that chart and really reflect upon where the dollar is in the bigger picture. And when you really observe that through the 1990s and into the 2000s, or at least the first decade of the 2000s, the sheer volatility the dollar index went through was enormous. I mean, we had swings of the dollar index go from 120 down to 70 in a span of like 5+ years. And, we stare at this dollar and like you were saying, on a relative basis compared to other fiat currencies, but there really has been a lack of dollar trend. I mean, the most we can really identify is that the dollar's been in a very specific trade range between the 90 and 100 level, which is historically a very narrow range for the dollar. And for anyone to be doing a victory lap saying that the dollar bear market is already underway, I think it's quite premature. Now, I'm not trying to even suggest something alternatively overly bullish, but right now, all we can really identify is that there's been a very pronounced trade range since 2014-15, and it's entirely possible that we stay within this range in the coming year. And so that'll be very interesting to see how this develops.
I couldn't agree more, Patrick. And, the way to look at this is at the beginning of 2015, that's 6 years ago, we entered this sideways consolidation pattern on the big chart here, and we're still in it. And there's no great surprise here. And I think we stay in it until there's a clear signal that we're coming out of it. Let's move on now to my favorite chart, crude oil futures. We're down a tick here. What do you make of this chart, Patrick?
Well, down a tick. I mean, this is the continuous chart going back to 1999. And so this is really just reflecting the different cyclicality of oil over that time frame. And while there's always the backdrop based upon the evolving market as to could circumstances arise where oil could once again rise to previous high ranges like north of 100. And now we certainly have a number of people that have suggested that's on the table. But when we really look at it back to the last 5 years and just on most narrow range, we've approached now the 2017-18 highs and at least temporarily paused along the previous overhead resistance. Maybe there's room for some squiggling as crude oil may backfill a move towards $60 on a bigger scale. But overall, the most interesting part on this chart will be, will there be a new pronounced oil bull market, which would basically mean that we'd have to break out of this resistance points around 2018, highs of around 75, and then really see a trend resume that could see us heading up to those much higher levels. Do you think that the conditions are there for that kind of a breakout?
Well, I think the conditions for that kind of breakout are coming. I'm not so sure that they're there right now. What we're seeing, to a lot of people's surprise, is actual builds on inventory when we thought there would be massive drawdowns. Now, I think there's a sentiment in the marketplace which is saying, boy, if we can just somehow get through August, that's the big crunch period because that's summer driving season. And once that's over, we're going to be able to breathe a sigh of relief and not have to worry about inventory drawdowns anymore because summer driving season's over. Remember the words of Phil Verlager, the energy economist who is extremely well respected, who told us that summer driving season has always been a myth. What it really is summer home building season. Now, I can attest from just the fact that my contractors won't return my phone calls that the builders are all super busy. They're going to continue summer home building season right through the fall into the winter. So I don't think that we're going to see as much demand drop off after Labor Day, as a lot of analysts expect. Now, I don't know yet that we're going to see a disappointment in August where the market just can't get going because those inventory draws everyone expected never happened. But I wouldn't be at all surprised, even if the price comes off in August, that as we get into September and October, if demand surprises to the upside, as that so-called summer home building season turns into autumn and winter home building season. Let's move on, though, Patrick, to page 4, natural gas futures. What are we looking at here?
You know, it's interesting because Brent inspired me to kind of want to dig in a little farther to see where we are in the cycle on a lot of these different commodities. And natural gas has been in an incredibly pronounced bear market that has more or less been in place since its 2008 highs. I mean, the pre-2008 period saw natural gas have the fundamental backdrop of being able to get up towards $14 on numerous occasions. But really, in the post-2009 period, natural gas has been bound by more or less a lower boundary of $2 and an upper boundary of, let's say, $5 on that encompasses the majority of the price action. And we're slowly edging toward the top of that range. And this is what a common theme that we're going to see on a lot of these charts, which is the question that are these commodities in the cyclical trade range, and they're just going to come to the top end of their range and circle back down, or are we genuinely seeing the beginning of one of these very big, pronounced commodity bull markets? And this is a question that's going to be solved in the coming year. But right now, we're approaching some pretty big overhead resistance levels in the next, 50 cents to $1 on the upside of nat gas. And it'll be really interesting to see how natural gas reacts once it starts correcting a little bit.
Let's move on to page 5 and gold futures. It kind of looks like a formative cup and handle pattern, doesn't it?
Yeah, and what's really interesting here, Eric, is that gold is one of the very few commodities, after we go through every single one of these charts, that actually has been in a sustained bull market pretty much since 99, 2000, right? So many of these commodities have gone through cycles higher and then mean reverted almost 100% of their prior rises. And the only commodity that really hasn't exhibited that behavior has been gold. And even though we've been in what's more or less a half a year consolidation of gold prices, which certainly has taken the wind out of the sails from a sentiment perspective, when you really step back and look at the way this chart is developed, this is still probably the most pronounced bull trend in most commodity charts. And I mean, we're holding at a stone throw away from that 2000 level. I mean, it is, I guess, it's still a couple $100, but when you look at this chart, this still looks structurally very bullish.
Patrick, I agree on the technicals, and I think the fundamentals are there too. Of course, we do have this issue of crypto and gold competing for the same market share, and I think that's been a big headwind for gold. But I wouldn't be surprised if the bottom is already in. I was hoping for a deeper pullback before this was over, but I'm not sure we're going to get it at this point.
So moving on here, Eric, what I wanted to do is to just circle to silver, the cousin of gold. And what's interesting is that the boom-bust cycle in silver to its 2011 high was much more pronounced. I mean, silver almost wiped out its entire prior 2009-2010 gain in the subsequent bear market that happened in the last decade. But what we really see is that silver had almost a 3-4 year trade range between this kind of more or less $15 to $20 range for the sake of rounding. And this breakout in silver is generally holding at these higher levels. I mean, at this stage, arguably, if this sideways consolidation we've seen here for the last half a year bullishly breaks out with a new high, this could send silver heading up towards testing some of those previous highs around $35 or more. It'll be really interesting to see whether silver will, in the coming half a year, break out bullishly to the upside.
It'll be very interesting indeed, Patrick. I can't help but look at this and say, there's a whole lot of silly money that went running into silver on the Wall Street bets. It's going to, what was it, 1,000? That stuff. When those folks figure out that was kind of silly, I think that potentially there's a big wave of selling that creates a buying opportunity. We'll see what happens. I don't think that those guys are going to get their $1,000 price anytime soon, though.
Generally, if your narrative comes out, I mean, I think it would still be structurally very bullish if all pullbacks on the silver stayed above 20, right? Where all the previous highs of that multi-year consolidation occurred. So long as silver had a short-term correction and let's say it dropped 10-15% in a sell cycle, found solid lows, that would be still conditions that would allow a bull market phase to ensue on the other side.
Oh, I'd be buying a lot sooner than 20. I'd be buying 22 hand over fist, but I do think that pullback could be coming for that reason. Let's move on to copper futures. This is another one where I hope the pullback's not over yet because I wish I had more exposure and don't want to buy it at these prices.
Yeah, for sure. I mean, copper hit a multi-decade high when it punched through $4.50 earlier this year. But it did have an enormous move on the upside, and that rally is now being checked. It reminds me a lot of the pullback in 2009, 2010 after copper made that huge move off the low. It paused there and mean reverted a good chunk, but that was only a midpoint before the continuation pattern. It'll be really interesting to see whether these pullbacks are more or less contained above $4 on copper in the bigger picture. If they are, I mean, that could be the buy on dip consolidation that allows copper to bust to all-time new highs and run pretty hard. But the observation here, which I think is the most important one to make, is there isn't much asymmetry in buying brand new copper positioning up here without, let's say, having some sort of option strategy to hedge it out. The tricky part is that while there's a very easy case to be made to be bullish copper, it's actually quite challenging to manage the risk on it. If you didn't get in on the copper bull market when it broke out $3 going back a year, it really is a much trickier entry here at these levels.
Patrick, I couldn't agree more, and I certainly don't want to be putting new money to work in a naked long here. I agree with you. You've got to have a hedged strategy if you're going to enter this market here. I'm personally hoping for a deeper pullback so I can get that long-term long position in place. Let's move on to a topic Brent mentioned in this interview, which is he thinks that if there's a pullback, soft commodities, he thinks may be the place to play. I see you've got a series of soft commodity charts here.
Well, I figured we throw them all up, at least the major ones, just to kind of put some context on the moves that happened and the potential moves still to come. And what's interesting, just to step back, and I attached articles to our research roundup, Felder report one where he shows where Jesse Felder puts up that generational opportunity commodities chart, which is taking the commodity index divided by the industrial index to show just on a ratio basis how cheap commodities are to the general asset prices. And while you can make the argument that commodities are cheap, when you look at the individual commodities themselves, it's interesting to see how far they've already come and what it would mean for a new bull market to ensue in many of these. And so I wanted to start here on page 8 with the wheat futures and looking at I chose two of the grains, wheat and soybean. And what we have here is there was a number of periods a decade ago that saw wheat prices temporarily advance up to levels in the 8-9 level on the upside, 800, 900 on this chart. But almost each time it was like the lumber chart where it was some short-term supply-demand imbalance that basically corrected itself and caused wheat prices to mean revert back to much more average prices. And this is going to be the interesting storyline here. First of all, there is room for these grains to generally advance still to higher levels. I mean, we have had essentially a sequence of higher highs and higher lows in bull trend, and there's no evidence that this trend has already stopped. But really the question here is this simply going to be a short-term trend move that is going to be emergent, or is it going to be much more like the gold chart where once it reaches higher levels, it's going to sustain up there for extended periods of time? And that's one of the bigger questions as to whether or not even inflation is transitory versus whether inflation is here to stay, is whether or not a lot of these commodities are simply structurally going to find much higher prices on a sustained basis. And watching with the breakout on wheat and on the next page, the soybean is the same thing. Like soybean is basically already traded to multi-decade highs. And so really to be bullish the beans for a bull market would mean that it's a bold call that these highs that were in place for the last decade are going to be broken, and somehow we're about to see a sustained new bull advance, which is not impossible. I mean, we saw in things like lumber, but that's pretty much what the call you'll have to be making right now if this is where you're starting your buying.
Well, I'm reminded of Darius Dale's interview a few weeks back and just what we know in general about markets, which is I think this is the beginning of a really big inflation. What happens in the beginning of something really big? There's a great big panic move up, and then everybody realizes that it was a little bit too much, too fast. It was overblown, and you see a great big retracement, maybe a 61.8 fib retracement, typically in that situation, and then that secular trend resumes. So I think Darius probably has it right that, the first panic wave has already played out, and now we're in the retracement before the resumption of what will ultimately be a huge bull market. What do you think of that view?
It's entirely possible. I mean, right now, I think what I was trying to achieve with this is simply seeing where we are in terms of new opportunities on a lot of these commodities. I feel that if the right fundamental backdrop is there for general repricing, but I think the part that you've alluded to in previous shows is about the social unrest that could happen if we did see this type of a commodity move. I mean, really, when it hits these types of commodities, that really ends up hitting the grocery stores. That really ends up hitting the average person that hasn't seen a meaningful pay raise in a long period of time. And right now, these commodities, while most of us have seen generally rising prices in the grocery stores, we haven't seen anything extraordinary. But if these soft commodities really start to bull run, I think that it's going to really be felt. I mean, it's going to be hard for it not to be felt in the pricing on the grocery bill, right?
Patrick, let's move on to page 10 and continue our review of soft commodities with cocoa futures.
Right, and it's interesting. This commodity has actually been the most trade range bound. I mean, while we've seen a number of commodities that have demonstrated cyclicality, this is really, especially in the last 3 years, been in an incredibly tight range, and we're trading at least to several year lows, or at least approaching it. It'll be interesting to see whether or not this, like a ping pong, just is bouncing between these trade ranges and a buying opportunity emerges here on these. So, Eric, though, what I wanted to do is move on to page 11, where I have the chart on cotton futures. And what's particularly interesting here is cotton back in 2011 had a parabolic rise that was very reminiscent of what just has been happening with lumber, and just had this really big squeeze that had that almost immediately mean reverted. But when you remove that one kind of outlier, you can define cotton as a trade range that more or less has stayed within the $50 to $100 range for several decades now. And we are trading right to that top of that trade range. And what an amazing crossroad this is on the cotton futures, because exactly like we were talking, is this transitory? Is this just temporary? Are we going to just hit the top of this range and trade back to the middle or bottom end of this range? Or do we have a breakout to almost a decade high with a breakout, let's say, to 100 or more, and see a new commodity bull trend emerge on the weekly charts this way? It's really interesting to see where cotton is today, and it'll be interesting to see whether that breakout actually does play out.
Now, look at the contrast in orange juice futures on page 12. We're nowhere close to the cyclical highs or the recent all-time highs.
Absolutely. And what is interesting, though, is that when you really step back and look at the behavior, this is one of the few softs that actually looks like you can get in at an asymmetric level. I mean, we had quite an extensive multi-year bear market in orange juice futures that saw it go from 220 to under 100. And for the first time in the last year, we have seen the characteristics of basing formations and higher highs start to establish. It'll be interesting to see whether orange juice futures are just breaking out of the gate here. That this is probably, out of all of the commodities, this one from a technical perspective looks the closest to being at the starting point of a new trend. It'll be interesting to see whether this breakout actually sticks.
Let's move on to coffee futures. Patrick, what's going on here?
Now, coffee has had an extraordinary run in the last 6 months. I mean, we've all seen coffee futures almost double off of their 2020 lows. And we've seen in the past that when coffee gets going, it can actually have a sustained trend. Now, obviously, it's hard to justify a brand new position after such an extraordinary move on the upside. But it'll be really interesting to see whether, as it mean reverts and corrects, whether old dips are being bought and whether there's another leg higher coming in these coffee futures. If you're looking for something that is just building momentum to the upside, this is definitely one of the futures to watch.
Now, take a look at lumber futures with that downside retracement continuing to the point where now lumber futures are literally trading at 1/3 of the price they peaked at just a few months ago.
And this brings me back to that cotton chart on page 11. And when you see these kind of huge runs on the upside and then the full mean reversions, clearly lumber is going to be impacted by inflation, and generally higher lumber prices make sense. But when you really put it in perspective, for several decades, the $200 to $400 range has contained lumber prices for, like I was saying, for several decades. And the fact that we had this extraordinary move was very much, I think, a nature of the illiquidity of this market and some short-term supply and demand imbalances that ensued. But what will be really interesting to see is that now that lumber is settling down a little bit after its extraordinary pop and drop, the question now is, does it stabilize at structurally higher prices? And I would say that even if we saw a short-term pullback even to 400, so long as we see 400 to 600 be the new higher trade range, that's still a substantially higher price of lumber than we have historically seen. And while I think I'm a seller on the idea that lumber is imminently going to head back to north of 1,000, we finally are seeing lumber reverting back to levels where one can entertain the idea of buying dips again.
Finally, on page 15, we've got sugar futures. What do we make of this chart?
Another one of these soft commodities that, more or less has been in a pronounced bear market for pretty much the last decade. We put some major lows in around the $10 level over the 2015 to 2020 period. And for the first time, we broke to a higher high, beating those 2019, 2020 highs in this recent advance. And while it's a little bit of a chase buying sugar at this moment, it'll be interesting to see whether this is now the beginning of a new potential bull run in sugar. If dips continue to be bought here, maybe we can see prices north of 20 and heading toward 25 on the top end of the range. So this is certainly another one of these softs that is going to be interesting to see as it develops here in the coming weeks and months.
Listeners, you can get Patrick's chart decks every single day with a free trial of Big Picture Trading. Information's on page 16 or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.